For investment clubs, taking back the step on what we have talked about when you set up your right goals and objectives and visions you want to achieve, and setting up your KPIs, and you say in 5 years we must be here. Right now we are starting in 2025. You are listening to we are having this conversation in 2025. You say as an investment club we have 500 million. Then you are going to go back and sit back and say in 5 years from now, by 2030, we should be at 1 billion or 1.5 billion. At 10 years from now, 2035, we should be at 5 billion. 15 years from now, that's 2040, we should be at maybe 30 billion in total investments made. When you set those KPIs principally and every member says, okay, I see the journey we have to take. Now, at the end of the day, you would have been in position to say, okay, I can see where we are going. I can see where the starting journey is, what my contribution is. Then I can see every single year what I have to hold my leadership accountable. And when it comes to treasury bonds, that should be part of your investments. Like I said, I'm encouraging you, investment clubs to move quite significant amount of money from unit trusts, because unit trusts are what we call liquid investments. Investment clubs are into long-term investments that sometimes even buying land will make you more money, especially if you can buy the 3-4 acres of land and subdivide it if you understand it at business. But when it comes to treasury bonds themselves, you have to sit back and say, we have 500 million as a group right now. In the next 5 years, what should be our target? In the next 10 years, what should be our target? In the next 15 years, what should be our target? And that guides you on which treasury bond to buy. If you set up a target that is 10 years from now, and you say, Mark, we are holding you accountable. In 10 years from now, we need our company to grow tenfold, which is from 500 million to 5 billion in 10 years from now. Automatically, you cannot buy a treasury bill. Why? One, the treasury bills, the profits you make on a treasury bill are low. Why? The tax on them is 20%. And the return, what we call the yield on them, is around 13 to 14%. That when you take off the 20% tax, the net return is around 10%, 11%. You might not achieve people's goals if you buy a treasury bill. One, because for you as Mark, as the leader, you have been set a standard. You have been given a mandate for 10 years, but accessible every 2-3 years or 1 year. Then you cannot buy a 2-year bond. Why? The return on it is around 14%. The tax on it is 20%. That means the return after tax is 11%. You have a 10-year mandate. Then you can't buy a 3-year bond. Why? The tax on it is high, 20%. The return on it is 14.5%. After tax, you come back to 11.8%. Then you say, okay, now I'm starting to make sense if my goal is to maximize value for people. Now let me go to the 10-year bonds, the 15-year bonds. Why? Right now, the 15-year bonds, where we are having this conversation, the 10-year bond is offering around 16%. The tax on it is 10%. If you take off from 16, you take off 10%, you come to around 14.4. If you secure an investment that guarantees you 14.4% for an investment club as a treasury bond, it means every 5 years, it would, and a half, 5 to 6 years, it would have doubled the money you have put in. And then all of a sudden you're like, oh, now this is different. When you set up a 15-year vision for the company, then you are okay to buy a 15-year bond, because you know you're not trying to achieve a short-term goal. You have a mandate to double, triple, grow people's investments for a 10-year period, and you're okay to take those decisions. You learn. Comparatively, if you have been having money in a unit trust, you have 500 million. You know, or let's say 300 million a year ago. You know They gave you maximum 35 million. Why? They give you 11%. Yet someone who has 300 million, if I'm to work it out here, last year, and they got a bond, let's say last year the bonds were offering an after-tax return of 14%, you know? So someone who has 300 million, they put it in a unit trust, they're going to get their 35 million. It's a good investment. Someone goes into a treasury bond, they buy a 10-year bond, they secure a 14% after-tax return, they're going to get 42 million. In 1 year, that means someone in the treasury bond has made 7 million more than someone in a unit trust. And that's okay. Why? Because the investment you're trying to make for the club is to maximize people's money. It's not to have money easily accessible. You must be willing to take certain risks and say, in a unit trust, you can access our money every single day. Maybe because we know we can take advantage of any investment that can ever come our way, maybe we can always put some money in liquid investments. And liquid investments, those are the money market funds. Apologies. Those are the unit trust funds, where you sit back and say, for at any one point, we should always have 10% in the money market fund. So if we have a total portfolio as a club of 500 million, then 50 million should be in the unit trust fund. The rest should go into where it makes the most money. Now, because this conversation is for the treasury bond, and because we have now set a benchmark to say, will you have a 5-year mandate, 10-year mandate, 15-year mandate, then you invest in those long-term bonds, because those are the ones which are going to maximize the return for your shareholders, the return for your investors, which for you as a leader, Alex, Mark, Jeff, your goal is to maximize the return for the investors. So you go into those. And then every single time they pay you a coupon, because it's an investment club, its goal is not to pay people dividend. You can actually set a dividend policy and say, we shall start paying a dividend in 10 years. When you set it up and say, in 10 years, we must be in a position to be where we are making, let's say, 200 million every single year. And then we can pay dividend of 50%. So the first 5-10 years, you are literally getting contributions, investing in them, getting coupons, investing in them. Everything is geared towards making money for this investment club. Everything is geared towards doubling people's money. And to do it that way is to say, if right now we are at 500 million from the conversation, and then you tell me every single month we collect 50 million, that means every single year you collect 60 million, right? At the end of the day, you are going to say, in 10 years from now, we shall be at 3 billion. If you invest in long-term bonds, that means there is no reason whatsoever you should keep so much money in a unit trust, because you are leaving a lot of money for the investors on the table. And when you have to look at it that way, you start to say, oh, in 10 years, we shall be in position to make 300 million in profits alone if we take this risk of investing in long-term treasury bonds. But it goes back for you having set the precedence, having set the KPIs, having set the objective. Otherwise, if you leave it in a unit trust, it will grow very well. If they are giving you 11.5, you can see, same amount, you are less than 500 million in 10 years. That means for you as a leader, you wouldn't have maximized the value for your investors. And that's where it comes back to say, can we set these early? That's not to say do not leave money in a unit trust, because you never know when you need something. But if you want to maximize value, maximize growth, you know where you have to go. And the fact that people are willing to contribute every single month, then you say we shall just always buy those bonds that fit within our risk. And at the end of the day, you will achieve your goals, or you'll do much better than a club which is so much risk averse. Thank you.